If you want to get started trading options, there's no better way to begin than with a high probability strategy that builds your account and, let's be real, your confidence. In this video, we'll teach you the easiest one, which can make more than an 80% return on capital in very bullish environments like 2023. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to develop numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from a professional trader on our desk so you can grow your trading account.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And one of the big trading misconceptions out there is that options are primarily used as a cheap way to take advantage of big moves on stocks through buying a cheap call option on a stock that you're bullish on, or buying a cheap put option on a stock that you're bearish on. And that's true. If you have a modest size account, there is some advantage to buying options rather than the stock from which those options are derived. But the truth is that buying call and put options is not normally going to provide you with steady income. It's more of a hit or miss practice, and it certainly can't be relied upon to produce steady income. On the other hand, the selling of options, or more specifically option spreads like we'll be teaching you in this video, can not only produce income on a very highly probable basis month after month, but is also incredibly easy to learn and understand. So stick around if that seems to be of some interest to you. If you're absolutely brand new to options trading and you don't know much about options or how they work, we've created a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand this very easy option strategy that you can trade each month. Then when you're finished, you can come back and watch the rest of this video. The best way to teach you this strategy, which is a monthly strategy, is to head back about 12 months to December 1st of last year, 2022. And as you can see, the S&P 500 index, which trades under the symbol SPX, the index had lost more than 25% of its value at one point during 2022, although it began to bounce and rallied back over 4,000, so that by December 1st, the index had closed at 4076.57, regaining some of its lost value from earlier in the year. And so let's suppose that on that day, you pulled up an options chain expiring at the end of the month of December on the last trading day of the year, which was December 30th, 2022. And on that options chain, you'll see a column called delta. Well, the delta of an option is based on a mathematical formula which basically predicts how much the price of that option will move based on how much the index itself moves. And how that works, we can cover in another video, but all you'll need to know for this video is that an options delta is highly correlated to the probability that the option will have any value at all on the day that it expires. Let's take a look at the 37.75 put option that we've highlighted on this slide. And as you can see, the options market is basically saying that the 37.75 put option has a 10.02% chance of expiring with some value, and therefore an 89.98% chance of expiring with no value. And the way a put option expires with no value is if the index closes above its strike price on the day that the put option expires at the end of December in this case. So if it has a 10.02% chance of expiring with value, then it's really telling us that the SPX index has an 89.98% chance of expiring above 37.75 when it expires in 29 days, which makes sense because the index is trading at 40.76, and so dropping to 37.75, more than 300 points within a month, seems pretty unlikely. And so that delta of 10.02% makes sense. It's got only a 10% chance roughly of expiring with any value at all. Okay, so with that in mind, let's suppose that on that day, you went ahead and sold 10 of those 37.75 puts for that price of $12.70, and you simultaneously bought 10 of those 37.70 puts for $12.30. Well, when a trader does that, selling a put higher up on an options chain and buying a put lower down on that same options chain, when a trader does that, he's entering into what options traders refer to as a put credit spread. And the reason it's called a put credit spread lies in the cash flow when you first enter the trade. You see, when you sell the 37.75 put for a price of 12.70, that price needs to be multiplied by 100 to account for the fact that index options pay off at $100 per point if the index closes below that 37.75 put option strike price, and you sold 10 of them. So when you multiply it all together, you end up receiving $12,700 for selling those 10 puts. But you then turn around, right around, and spend most of it, $12,300 to be exact, on buying the protective puts down at 37.70, resulting in net positive cash flow of $400, which will flow right into your broker account. And in fact, you'll see the cash balance of your broker account increase as soon as you enter into this trade. And that's why it's called a credit spread, because you receive a credit in your broker account for executing this trade. And because it's done with put options, it's referred to as a put credit spread. And so let's move to the day that this put credit spread expired, which is December 30th. And as you can see, the SPX index actually sold off and closed the year at 38.3950. And because the options expired that day, they can be assigned a final value. So let's analyze what happened with our put credit spread trade. Well, starting with the $400 in cash that we first received, with the index closing at 38.3950, well, the 37.75 puts expired worthless because the index closed 64.5 points above its strike price. And similarly, the index closed 69.5 points above the 37.70 strike price puts. And so since both options expired worthless, the resultant profit is exactly equal to the cash flow we received at the outset of the trade, that $400. Let's start a scorecard of how this trade is going, because we're going to be doing this every month for 12 months. And so our first entry is that $400 gain on December 30th of 2022. Okay, now what's important to understand is that even though the market sold off, it didn't sell off all the way down to 37.75. It stopped at 38.3950. And so it really paid off that we sold the 10 Delta 37.75 puts and bought the one 5 points lower, because that was a decent size sell-off by the end of the month, dropping from 40.76 to 38.39 in 29 days. Yet we still made our full profit on the trade because we picked a strike so far away with a 90% chance of expiring worthless that we had a very large margin of safety on the trade, and that margin allowed both options to expire worthless, which in turn gave us the ability to just go ahead and pocket and walk away with that $400 in profit. You see, with a put credit spread, as long as the index closes even 1 cent above the short put, you get to keep the entire credit you received at first. And so if we place the short put well below where the market is, such as at the 10 Delta strike, then our chances are really high that we're going to be able to pocket that entire credit that we first received. And that's the secret, actually, to the high probability of selling 10 Delta put credit spreads. And so let's now move to the January trade, which you'd start just as soon as you close your December trade, rolling your capital over to the next trade, the January trade. And so finding the 10 Delta put for January, given that the market had sold off to 38.3950, then that put option, 90% likely to expire worthless. In other words, the 10 Delta put option in this case is now down at 35.35. So we sell 10 of those 35.35 puts, and we also just go ahead and just like the previous month, we buy 5 points lower, the 35.30 puts. And if you think about it, we've given ourselves 300 points of wiggle room here, because even if the market goes down 300 points, the 35.35 puts, and obviously the ones below that, will expire worthless. And so you're starting to see why this is such a high probability trade, because we're giving ourselves such a giant margin for error. And so looking at this January trade from a cash flow perspective, using the same calculation as we did on the December trade, you can see that the 12.95 we brought in, selling the 35.35 puts, is largely offset by the cost of the 35.30 puts, resulting again in net cash inflow, this time of $450, which means that the worst case scenario on the trade is, in this example, $45.50, which is the capital amount that your broker is going to require you to put up for the trade. Now, moving to the day that this put credit spread expired, January 31st, we can see that SPX actually bounced over 200 points by the end of January. And so obviously both the 35.35 and the 35.30 puts, both are going to expire worthless, resulting in another gain this time in the amount of $450. And so we'll go ahead and update our scorecard for that trade, as well as all of the trades we made for the rest of the year using the exact same approach each month, so as not to be too repetitive in this video. And we'll bring it right through to November of 2023, as you can see, in order to provide you with a full 12 months of data. In each of these trades, we opened the trade at the very end of the previous month and closed it a month later in each case. And as you can see, in each of the 12 months, the SPX index closed above the strike price of the highest put. In other words, the short put in each case, resulting in 12 straight wins over the last 12 months, culminating in a total return of $4,050. The most capital our broker ever would have required of us in any of these months was $4,750, which means that a return on deployed capital for the year was 85%, which is extraordinary, but which shouldn't be a huge surprise given the giant room we were giving each trade, as we showed you in the first two cases, but also the fact that 2023 was a pretty bullish year, which is going to be positive for this strategy, obviously, and which accounts more than anything else for the fact that the strategy won in each of the 12 months we studied in this case, which is a little bit higher than usual because a 10 delta trade suggests that you're going to win 90% of the time, but you're also going to lose 10% of the time because approximately 10% of the time the index will close below the short put strike, which means that put will make a payout to the one you sold the puts to, which most likely would create a loss for that month. But in this year, we happen to win 100% of the time, which can largely be attributed, as I say, to the bullish year more than probably any other factor. Now, before we wrap up, I wanted to point out that in less bullish years, this strategy will sometimes be in danger of a loss. And so some of you out there are probably wondering, hey, how do we handle these circumstances? And so I wanted to show you a trick that works sometimes to get you out of a loss. And so let's head back to the last trading day of August 2022, when the SPX was trading at 39.55 exactly. And so we'll start the same trade, seeing a 10-lot, 5-wide put credit spread expiring a month later on September 30th. And as you can see from the cash flow analysis, the trade, similar to other ones we've looked at today, brought in a $400 credit. And so the trade starts normally. However, in this case, the market starts to sell off pretty hard after an initial bounce. And by the time we get to September 23rd, the index has dropped all the way down to 3687.29. And so the market has dropped 268 points since we first put the trade on. And what was originally very far away from where the short put is located is now starting to get uncomfortably close. And one way to objectively measure this is by looking at the delta of the short put, which in this case has now increased to 20 from the original 10. And so what that means is that the chances of those short puts at 30.55 having value on expiration day has now increased from 10 to 20%. And since you're the one who has sold those puts, that means the chances of you having to make a payout under those puts has now increased to 20%. And while that doesn't sound like a lot, it is in fact double the probability that you originally entered at. And that is a line in the sand that for some options traders is enough. And so what some traders like to do in this circumstance is to basically return the probability back down to 10%. In other words, they want to make the trade safer by what options traders refer to as a roll of the put credit spread down back to 10 deltas. And so, for instance, in this example, you could see that we rolled from the original 35.55, 35.50 put credit spread, closing that spread, buying back the short puts and selling the long puts, and moving the whole operation down to a new location 80 points further down to the 34.75, 34.70 put spread. You'll also notice that we increased lots to 50% more. In other words, we are now trading a 15 lot. Let's break down exactly what happened here from a cash flow standpoint. And as you can see, the prices on the puts we originally executed, the 35.55 and the 35.50, both got very large. So it cost us a lot to buy back the original 35.55 puts, but we also received a lot for selling the 35.50s. And then we went down and sold 15 of the 34.75s, for which we received over $13,000, and turned around and paid over $12,000 for the protective puts at 34.70. And so when we crunch all of the numbers together, you can see that we still have a remaining cash flow, but it's been cut in half down to 200, which is going to happen in tougher months because it can get very expensive to buy back those short puts. And even though we've increased lots to 15, you still have a reduction in profit potential on the trade, as happened in this case. Also, be aware that when you increase your lot size, it's going to increase your capital requirement as well. So if you want to trade this way, you'll need to carry some additional capital in your account for a rainy day like happened in this case. Moving ahead to the day that the trade expired on September 30th, you can see that the index continued to sell off, closing at 35.85.82 on expiration day, which was September 30th. And so just as we have in the past, we take a look at the final value of the trade, and taking into consideration that we still had that $200 left after rolling, and the fact that both the short and long puts expired more than 100 points below where the market finally closed on the day they expired, as explained before, those are going to therefore close with no value, meaning that we get to keep that $200. In other words, by carefully managing our trade, pushing the put credit spreads farther away from the market, we were able to make a profit on the trade, a trade which looked like it was really headed for trouble. And so what I'd like you to take away from today's video is that the 10 delta put credit spread is a terrific beginner strategy that can win in a number of different market environments. And for more challenging environments like last year, by using the roll technique that we showed you in the video, you have a good chance to salvage trades that were troublesome and turn them into wins. That's the kind of approach that builds your confidence as an options trader.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.